All right, so let's begin the show, and today let's focus on the right way to opt for a systematic withdrawal plan, which is SWP. Reasons for you to opt for this particular service, and how can you tailor make your investments, how to ensure you are getting the right amount that's needed via SWP, and accordingly, how can one invest right for that? Is it also the most tax efficient way to grow your wealth? Let's discuss all of this. I have with me Arun Kumar, Head of Research of Funds India. Arun, good evening and welcome to the Money Show. A very popular concept, systematic withdrawal plan, but a lot of people are unaware about the nitty-gritties, and when we deep dive into it, there are a lot of technicalities, which get lost in the entire concept. So first come first, let's just understand a very basic concept. What is systematic withdrawal plan, and is it only something that's offered by mutual funds?
Yeah, hi, Kavita. So, systematic withdrawal plan, while it looks like a very complex concept, in essence, if we take a step back, let's assume you have any mutual fund and you need to withdraw a particular amount every month. Usually, the way you do, let's say you had 10 lakhs in a particular fund A, then you wanted to withdraw, say, 5,000 every month. Now you'll have to manually go open your app, do the redemption and then take it out. Then again, next month, you'll have to remember to do that on the same day. So basically, the idea was mutual fund said, hey, if you're going to do it on a regular basis, we will let you automate it. Right now, you can choose the date, you can choose the frequency. It can be weekly, it can be monthly. So in essence, an SWP is just the automating process of taking money out of your mutual fund, and whatever is the amount and whatever is the frequency that gets defined by you. So the other way to think about it is exactly the opposite of an SIP, where you decide what to invest, when to invest, and how long to invest, and then that is automated so that you don't need to do it automatically. It's taken from your bank account, put into a mutual fund. This is just the opposite. Every time your money is taken out of the fund that you have chosen, and it automatically gets deposited into your bank account. Usually, the use case for this is that if you're retired, or let's say you're financially free and you want money from your portfolio to support you, you can use an SWP plan, so that for whichever funds that you've chosen, so that every month, without you having to manually do it, it automatically hits your bank account. And so that's the broad use case for which SWPs are used. It's not a strategy, it's just a simple automating system. So it's more a convenience. So you have to look at it more from a convenience standpoint.
So it's more of a convenience feature that you can apply to your investments. But having said that, now if you are an investor, Arun, who knows that you might want to opt for SWP, maybe after a certain period of time in your life where you might want to have a regular income out of your investments, how can you go back and maybe plan it accordingly? In order to get a certain amount of money every month, you should be having a certain amount of investable amount, that will also grow. Along with you getting a regular income, it's important for you to make sure your investment amount is also growing. So what is the maths in it, and how can one plan for it? Because that's the most difficult part.
Right. So as you rightly mentioned, the trade-off is between three factors, right? One is there is a particular amount that I require every month. So this is my first factor. And the second part is that this amount will also have to grow because there is inflation, and I can't have the same amount getting withdrawn every year, because by next year the inflation is also much higher. So I want this amount to also grow, which is my second factor. And the third part is that the entire portfolio that I have built, I don't want to see it because I'm withdrawing. I don't want to see it negative. I also want that portfolio to grow. So I have these three factors, and obviously any factor which I overdo will have an impact on the other two factors. So the essence is, how do you create a trade-off between all three and ensure that you also end up getting the right amount that you want every month. So the way to start off with is a rough thumb rule would be that you should at least have 25 times your annual money requirement as your portfolio size to build a good monthly income kind of a solution. So let's say if you want, say 1 lakh every month, then for an entire year, you would require 12 lakhs. So 25 times of that would roughly be close to 3 crores. So this is the first part of it. Now, the second part is you obviously want this money to also grow. So which means that this year I will take 1 lakh every month, but next year, assuming inflation at let's say 5%, so you might want to take 1 lakh 5,000 the next year, and post that again you want to increase it by 5%. So this is the second part. The third part is you also want your original 3 crore portfolio also to grow, say at say 3, 4, 5%, but you want some growth there. You don't want that to come down. So these are the three. Now, how do we put it in place using mutual funds? A simple thumb rule would be to have a 2-bucket system. The first bucket is 85% of your portfolio. The second bucket will be 15% of your portfolio. So 85-15 is the thumb rule. Now, let's say you have 100 rupees as the portfolio from which you will have to build this monthly income solution. First, you put a 15 rupees into a very, very safe short-term debt fund. So this will be your buffer. Just in case something goes wrong, this is the bucket that you will use to take the money out. But this is mostly from a safety perspective. But the remaining 85%, that is out of 100 rupees, the 85%, you can use it. I mean, you can deploy it in an aggressive hybrid fund, which will have roughly 70% equity and 30% debt. Now, if you want to slightly make it more conservative, you can also use a product called Balanced Advantage Fund, where your equity allocations will generally move between 30% to 80% of the portfolio. So the idea is 85 rupees goes into aggressive hybrid funds and 15 rupees goes into debt funds. Now, the next thing that you do is once you have set this up, then you go to the aggressive hybrid funds and then set up an SWP for every month. Now, this can be roughly totaling to 4% of your portfolio per year. So you divide it by 12 and you will know the rough monthly amount to be set. And then you set it up running. Now, obviously, this has an equity component. So the second part that you will have to do is that if there is a market fall, say more than 15%, you will have to stop the SWP from this particular 85 rupees, which is your core portfolio, and then do the SWP for the same amount from your debt portion, which is safe. Then again, once the market recovers, you can shift the SWP back into your 85% core equity portfolio. So sorry, the core aggressive hybrid portfolio. So in this way, you can ensure that you get a regular income from your core portfolio. But if at all there is a large market correction, you can also shift it to the safer debt portion. And the third thing that you'll do is every year, you will also be increasing the SWP amount by 5%. So overall, the idea would be to get 4% from your portfolio every year. This you will increase it by 5% every year. 4% from your portfolio is your money that you will use for your requirement. Second is you will also increase it by 5%. The third part is that you will also want your portfolio to grow. So roughly 3 to 5% is a good number to look out for in this particular plan. The overall assumption is that at a portfolio level, you might try to attempt a 10% plus kind of a return. So this is how you can put in place a simple SWP system which can work over long periods of time.
All right, but then in order to have a withdrawal plan of 4 to 5% and annual increase of 5%, Arun, one also needs to come down to that particular figure that needs to be invested after a certain period of time. And also talking about the taxation, because I think that is one very important aspect and also a very big positive for SWP, I guess.
So actually there is no particular advantage because of an SWP, because in essence it's just a feature where you are withdrawing from a particular fund. Instead of doing it manually, you've just automated it. So again, back to basics, that whichever fund that you are withdrawing from. So let's say today I decide to withdraw some money from an equity fund. So the equity taxation will apply. So in this case that we discussed, where 85% goes into aggressive hybrid funds, it has equity taxation. So which means if you are taking out the money for the first 1 year, you will get a tax of 15%. But post 1 year, if it is less than 1 lakh, which is your capital gains, then you don't need to pay any tax. But once it crosses the 1 lakh, you will have to pay a 10% tax. So based on your monthly income that SWP that you're taking out, you will know what are the gains, and it will be a very it'll be a very small amount in terms of the tax impact won't be very high. The remaining 15%, if it is a pure short-term debt fund, then you will incur debt taxation. In other words, it will be added to your salary and you'll have to pay your tax slab. So let's say if you are on the higher tax slab and you want the equity taxation, then arbitrage funds can be one more safer option. You want to slightly increase risk on this portion, which is not advisable. But let's say if you want, you can also look at very, very conservative equity savings fund, which will have probably 10-20% into equity, and the remaining goes into arbitrage and debt. But the advantage is you will get equity taxation. This can be this can also be explored if you're okay with little more volatility on this 15%. This probably I wouldn't suggest, but this is also one more flexibility that you have. So this is how the taxation kind of works.
All right. Anything specific for senior citizens that one must be keeping in mind, Arun?
So the key, the key thing to remember is that one is that your income will need to adjust. So most people come with the fact that, hey, 4-5% seems very conservative. Why don't I go for 8%? But the problem is you also have to realize that this amount will will have to consistently grow every year, because there's at least a 5-6% inflation that you'll have to account for. So which means that you will have to start with a slightly lower amount, and your corpus will have to be at least 25 times to accommodate for this increasing monthly requirement that you'll have. So the first thing is, do not forget inflation when you are accounting for your monthly income solution. The second part is that volatility is almost a given. So in that sense, a 10-20% fall happens in equity markets almost every year. When we looked at the last 43 years, there were only 3 years where the fall was less than 10%. Every other year had a fall of more than 10%. So 10-20% is a given. And once every 7-10 years, there'll also be a larger fall of say close to 30-40-50%. COVID was a classic case. 2008 was a classic case. 2000 was a classic, but these are very rare. There are once in 7-10 years, but obviously for a retirement tenure of 30-40 years, for sure you'll at least have 3 or 4 instances of a very large fall. So you will have to be mentally okay that there will be 1-2 year temporary periods where your portfolio might seem to be reducing a lot. But again, for the alternate can be, you should avoid equity, but that is also not a great suggestion, because otherwise you will never be able to get the growth in your portfolio. So equity component definitely has to be there. If you start reducing your equity component while the volatility reduces, you will also impact the third part, which is your growth in your portfolio. So to balance it out, you need equity. You need to be okay with the volatility, and which is why we built that 15% net, so that every time there is a fall, you can shift your SWP into the safer debt funds, then again get back to this once the market recovers. So overall, putting it together, don't forget inflation. Make sure you have some equity portion. Third is, depending on the equity portion, be prepared for the fact that there will definitely be temporary falls and you will have to ride them out.
That will be all on how to implement systematic withdrawal plan on your investments. Thank you so much for being on the show today. Thank you.
Thank you.